Hello, everyone. Today is already the 14th of April 2026 as I'm recording this video in Hong Kong. And today I really want to talk about why who is so obviously effing around in the oil futures market might be about to find out in 7 days. However, I also want to give everyone a scenario why this person might be right and why this massive arbitrage between spot oil prices and futures can effectively suddenly shut and prove these reckless traders eventually right. Even though, personally speaking, I think that the likelihood of this scenario is lower and lower. At 10 a.m. Eastern Time on Monday, the U.S. Navy officially began a blockade of the Strait of Hormuz, turning the world's most important oil choke point into the epicenter of a fresh pricing shock. In theory, at least. Why in theory? Because if you only look at what happened to the price of oil futures starting from roughly 10 a.m. Eastern Time on Monday, it will be very hard to see any glimpse of a worsening oil supply shortage. As a matter of fact, oil future prices started to head significantly lower right before the US Navy blockade officially began, clashing with any basic logic. However, not everything moved against basic logic. Spot prices for crude oil across major trading hubs around the world moved higher. Even though I have warned about this plenty of times recently, today I want to dive into the details of what this huge discrepancy means for the WTI May 2026 to June 2026 futures contract rollover that is due in exactly 7 days from now. Today, we will look together at whether the spread between spot and future prices reflects a tradable arbitrage, and if that is the case, how it will be exploited, while, on the other side, someone playing around with oil futures in the market too much might be about to learn how settlement and deliverability really work. In 7 days from now, the NYMEX May 2026 oil futures ends trading. Now, please take a look at the latest spot prices of crude oil according to Platts. As of April 13 North Sea Platts window, North Sea Fortis crude outright price hit $148.87 a barrel. This price exceeded its 2008 peak, marking a new all-time high. The total bid equated to about dated Brent plus $19.55 FOB, compared to Friday's level of dated Brent plus $18.85 FOB. Meanwhile, the May 2026 WTI contract is currently trading at roughly $96 a barrel, while the June 2026 contract sits at roughly $90 a barrel, a steep $6 backwardation in the calendar spread. Putting it all together, this means prompt physical crude is trading at roughly $50 a barrel above the paper May futures. For reference, please note that the dated Brent, that is the real-world physical benchmark for North Sea and much of global pricing, is currently trading at roughly $132 a barrel. NYMEX WTI futures at expiration must converge to the physical settlement value at Cushing, Oklahoma, is the delivery point. With only 7 days left, this gap between physical and paper oil markets cannot persist. It is a textbook reverse cash and carry arbitrage setup, where futures are deeply undervalued versus spot. Now let's talk about how the arbitrage can be exploited. Large physical traders and refiners, exactly the names already bidding in the Platts window, such as Trafigura, Mercuria, Total, etc., can execute these buying May 2026 WTI futures, stand for physical delivery at Cushing during May, or use exchange for physical trades to convert the futures position directly into physical WTI or WTI Midland barrels. Transport and export the barrels with pipelines to the US Gulf Coast if needed, then load onto tankers for CIF Rotterdam or similar. And lastly, sell into physical spot market at the elevated Platts levels. The net profit would be roughly $40 plus per barrel spread minus logistic, transport, storage, financing, and quality adjustment. That overall can account between $8 and $15 a barrel all in for this route. Still an enormous locked-in margin for anyone with pre-arranged shipping and offtake. This is precisely what the bidding houses in the Platts window are set up to do, considering they already have the logistics and end buyers lined up in Europe and especially Asia. How is what I described expected to impact WTI future prices heading into the rollover? May 2026 futures are expected to see a strong upward pressure. Arb buying will dominate any normal rollover selling. Expect May to rise sharply toward physical parity. It cannot stay at roughly $96 a barrel. Spot physical might see a mild downward pressure. Increased deliveries and exports from the Arb will add effective supply into the tight prompt window, potentially easing the extreme premiums slightly. June 2026 futures might see a modest upward drift. With standard rows, that means sell May and buy June, provide buying support. If the market reprices ongoing physical tightness into the next month, June could rise too, but so far less dramatically than May. The May-June calendar spread will likely narrow from the current $6 backwardation as May catches up faster, though heavy rolls could keep it wide, or even widen it temporarily if our buying in May is aggressive. Summarize, WTI May futures contract will be pulled up hard towards spot before expiration, while the June contract, that will be the new front month post-rollover, will inherit some of the tightness but start from a lower base. The market, as it always ultimately happens, will largely self-correct via arbitrage flows. Let me now address the question I assume is on everyone's mind. What if a sudden full US-Iran peace agreement is announced before the WTI rollover? Even if the Strait of Hormuz fully reopened and sanctions lifted immediately, everyone in the market knows from historical precedent and logistic realities that it will take at least 2 months for meaningful extra Iranian barrels from the Strait of Hormuz to reach global buyers. Production ramp-up from shut-in fields, tanker repositioning, loading schedules at Carg Island and other terminals, and voyage time all create that built-in delay. The prompt physical market for May 7 to 17 loadings therefore remains generally tight in absolute barrel terms. Nevertheless, this is the exact scenario in which the May 2026 WTI arbitrage opportunity still fails to materialize before the 21st of April expiration, because the geopolitical risk premium collapses instantaneously across the entire forward curve as traders price in the certainty of eventual supply relief, even if it is delayed until mid-June or July. Dated Brent and 40s outright prices will fall sharply from roughly $148 towards the $105–$115 barrel range, not because extra oil is already flowing, but because the fear trade evaporates and sellers rush to offload before the anticipated glut psychology takes hold. NYMEX WTI futures sell-off are on the same forward-looking narrative. May 2026 drops from $96 towards $88 to $92, and June 2026 falls in tandem, or even more, as the market now discounts abundant supply into Q3. Why does the arbitrage window slam shut before it can be exploited? The classic reverse cash and carry trade, that means buy cheap May futures, take delivery at Cushing, export and sell into rich physical, never gets off to the ground for 3 reasons directly tied to the 2 months normalization lag. First of all, physical premiums compress faster than logistic can move. Secondly, futures sell-off outpaces any potential arb buying. Third, the timing window is too narrow. With only 5 to 7 days left until NYMEX expiration, there is simply not enough time to line up vessels, secure export capacity from the US Gulf Coast, and execute the physical leg, especially when the spot bid levels have already collapsed. Most houses simply cancel or sharply reduce their Platts bids rather than risk being long physical into a psychologically oversupplied forward market. In summary, the 2-month normalization lag does not preserve the extreme physical premium in this scenario. It actually accelerates the collapse of the fear-driven bids and the futures sell-off. The market reprices instantly on forward expectations. The Platts windows bids evaporate, and the arbitrage opportunity disappears before the bid physical houses can act. Prices reconcile lower across spot, May and June contracts, with the delayed supply relief already baked into traders' psychology well ahead of the first extra Strait of Hormuz barrel actually arriving. This is how geopolitical relief rallies in reverse can unwind oil backwardation even when the physical barrels themselves are still weeks or months away. With only 7 days left until expiration, the actual path taken will be determined far more by geopolitical headlines than by conventional supply and demand fundamentals. Ultimately, each trader's or investor's personal assessment of the scenario's probabilities becomes the single most important variable. Those who correctly weigh these scenarios will decide whether to lean into the arbitrage, edge against its potential failure, or stand aside. In such a compressed time frame, the subjective probability judgment will separate the winners from the rest during what is shaping up to be an exceptionally volatile rollover. Thanks a lot for listening to my new update today. Please don't forget to like the video, subscribe to my channel, and turn on notifications if you don't want to miss any of my future updates. And again, thanks a lot for supporting me on X, on Instagram, and for reading my research on justdario.com. I wish everyone a nice day.